Hello, and welcome to our comprehensive guide on preparing for the 2026 U.S. tax season. You might be thinking, the 2026 tax season? That's ages away. And on the surface, you're right. But the smartest financial moves are always made by looking ahead, not by reacting at the last minute. The tax return you will file in early 2026 is for the tax year 2025. This means that every financial decision you make, starting from January 1st, 2025, will have a direct impact on the taxes you owe or the refund you receive in 2026. This series is designed to be your forward-looking guide, helping you understand the potential landscape so you can navigate the coming year with confidence. Before we dive deep, it is essential that we start with a very important disclaimer. Please note that the information provided in this entire series is for educational and informational purposes only. It is not intended to be, and should not be taken as financial, legal, or tax advice. Every individual's and every family's financial situation is unique. Tax laws are complex and subject to change. Therefore, it is crucial to consult with a qualified professional, such as a certified public accountant, CPA, or a licensed tax attorney, who can provide advice tailored specifically to your personal circumstances. Our goal here is not to give you answers, but to empower you to ask the right questions and to understand the key topics to discuss with your trusted advisor. So, with that said, let's explore the core question. Why the urgency to talk about 2026 taxes right now? The primary reason is that the year 2025 marks a pivotal moment in recent U.S. tax history. It is the year when many of the significant provisions from the Tax Cuts and Jobs Act of 2017, often referred to as the TCJA, are set to expire. Think of the TCJA as a temporary set of rules that has shaped our tax filings for the past several years. It lowered individual income tax rates, nearly doubled the standard deduction, expanded the child tax credit, and capped the deduction for state and local taxes, among many other things. For millions of Americans, these changes have become the new normal. However, unless Congress steps in to pass new legislation, this normal is scheduled to come to an abrupt end on December 31st, 2025. When these provisions expire, the tax code is set to revert to the rules that were in place back in 2017, but adjusted for inflation. This potential shift is not just a minor tweak. It represents a fundamental change in how much tax many Americans will pay. The standard deduction, which is the amount of income that is not subject to tax, could be cut nearly in half. This would mean that far more people would need to consider itemizing their deductions again, a process many have not had to think about for years. The tax brackets themselves are also slated to change. The current rates of 10, 12, 22, 24, 32, 35, and 37% would revert to the previous structure of 10, 15, 25, 28, 33, 35, and 39.6%. For many, this could mean paying a higher marginal tax rate on their income. Families with children would also feel a significant impact. The child tax credit, which was substantially increased under the TCJA, is scheduled to revert to its previous, smaller amount. The rules for eligibility and refundability could also become more restrictive. These are not small changes. They have the potential to affect your paycheck, your budget, and your overall financial strategy for 2025 and beyond. This is why we are starting this conversation now. Being aware of these potential changes before the year even begins allows you to plan proactively. You can start thinking about your withholding from your paycheck, your retirement contributions, your charitable giving strategies, and how you manage your investments. Waiting until December of 2025, or even worse, until March of 2026, to consider these things will be far too late. The opportunities to optimize your tax situation will have already passed. Throughout this series, we will break down these potential changes one by one. We will explore what the expiration of the TCJA could mean for different types of taxpayers, from single individuals and married couples to small business owners and retirees. We will discuss the potential return of certain deductions and the disappearance of others. We will look at how to approach tax planning in a year of uncertainty, emphasizing the importance of good record keeping and staying informed. Our aim is to transform your view of taxes from an annual, stressful event into a manageable, year-round component of your personal financial health. By understanding the road ahead, you can make informed decisions rather than being caught off guard. It's about shifting from a reactive mindset, "How much do I owe?" to a proactive one. What steps can I take throughout the year to achieve the best possible outcome for my financial situation? So, thank you for joining us on this journey. Taking the time to listen and learn now is the first and most important step toward mastering the 2026 tax season. In our next chapter, we will take a much deeper dive into the single most important topic on the horizon: the sunsetting of the Tax Cuts and Jobs Act. We will unpack exactly what it is, which key provisions are on the chopping block, and what the pre-TCJA world could look like for your wallet. Stay tuned. Welcome back. In our first chapter, we set the stage, emphasizing why it's crucial to think about the 2026 tax season, which covers the 2025 tax year, well in advance. The core reason, as we touched upon, is the scheduled expiration of many key provisions of the Tax Cuts and Jobs Act of 2017, or TCJA. In this chapter, we're going to dive deeper into that topic. We'll unpack what the TCJA really is and, more importantly, what the world might look like for taxpayers if its major individual tax changes are allowed to simply fade away. Once again, a friendly reminder that this discussion is for educational purposes. It is not tax advice. We are exploring potential scenarios based on current law, which states that these provisions will expire. We strongly recommend speaking with a qualified tax professional to understand how these potential changes could specifically affect your personal financial situation. So let's start with a brief history. The Tax Cuts and Jobs Act was one of the most significant pieces of tax legislation in decades. Its stated goals were to simplify the tax code for individuals and make the U.S. more competitive for businesses. For individuals and families, it made some very noticeable changes that have influenced every tax return filed since 2018. The key word here is temporary. While many of the corporate tax changes were made permanent, a vast majority of the changes for individual taxpayers were written with a built-in expiration date: December 31st, 2025. Think of it like a subscription service for a set of tax rules. We've been using this service for years, and now, the subscription is about to run out. If Congress doesn't act to renew, extend, or replace it, the system automatically reverts to the previous rules. Let's break down the 4 most significant changes that are set to expire, and what their reversion could mean. First, let's talk about tax rates and brackets. The TCJA lowered the income tax rates for most individuals. The 7 tax brackets were adjusted to 10%, 12%, 22%, 24%, 32%, 35%, and 37%. If these expire, the rates are scheduled to revert to the pre-TCJA structure: 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. What does this mean in practical terms? It means that for the same amount of taxable income, many people would find themselves in a higher tax bracket. For instance, a married couple filing jointly with a taxable income of $100,000 falls into the 22% bracket under the TCJA. Under the old rules, that same income level would fall into the 25% bracket. This change alone could translate to a higher overall tax bill for millions of households across the country. It's a direct impact on your take-home pay and budget. Second, and perhaps the most impactful change for the largest number of people, is the standard deduction. The TCJA nearly doubled the standard deduction. This was a massive shift towards simplification. By creating such a high threshold, it meant that far fewer people needed to go through the complex process of itemizing deductions, things like mortgage interest, state and local taxes, and charitable contributions. For the 2025 tax year, under TCJA rules, the standard deduction is projected to be around $30,000 for a married couple. If this provision expires, the standard deduction would be cut almost in half, reverting to its inflation-adjusted 2017 level. In this scenario, millions of taxpayers who have been taking the easy standard deduction for years would suddenly find that it might be beneficial to itemize again. This means a return to meticulous record-keeping for charitable gifts, property taxes, and other deductible expenses. The simplicity that many have grown accustomed to could be replaced by the more demanding task of tracking and documenting expenses throughout the entire year. Third, let's discuss the child tax credit. The TCJA increased the credit from $1,000 to $2,000 per qualifying child. It also significantly raised the income thresholds at which the credit begins to phase out, making it available to more families. If this expires, the credit is set to revert to its original $1,000 per child. Furthermore, the income phase-out levels would drop dramatically, meaning some higher-income families who currently receive the credit would no longer qualify for it at all. This potential change represents a direct reduction in financial support for families with dependent children, impacting household budgets and savings goals. Fourth is the state and local tax, or SALT deduction. This has been one of the most talked about provisions of the TCJA. It introduced a $10,000 cap on the amount of state and local taxes that taxpayers can deduct from their federal income if they itemize. This includes property taxes, and either state income or sales taxes. This cap heavily affected residents of high-tax states. If the TCJA expires, this $10,000 cap disappears completely. For taxpayers who itemize, especially those in states with high property and income taxes, this could be a significant benefit, as they would once again be able to deduct the full amount of these taxes. However, it's important to remember this change only benefits those who itemize their deductions. With the standard deduction potentially being lower, more people may find themselves in that category, making the removal of the SALT cap a highly relevant issue. These four areas, the tax brackets, the standard deduction, the child tax credit, and the SALT deduction cap, represent a seismic shift in the federal tax code. It's not about one small rule changing. It's about the interconnected foundation of the individual tax system reverting to an older model. Of course, it is entirely possible that Congress will act. They could extend some provisions, modify others, or write entirely new laws. But in the world of financial planning, you plan for the default scenario. As it stands today, the default is expiration. Understanding this default is the first step in preparing for any outcome. In our next chapter, we will focus specifically on the ripple effects of these changes. We'll explore the dynamic between the standard deduction and itemized deductions, and how you can start preparing now for a world where itemizing might once again become the norm for your family. Hello and welcome back to our ongoing discussion about the 2026 tax season. In our last chapter, we took a closer look at the major provisions of the Tax Cuts and Jobs Act that are set to expire at the end of 2025. We discussed how tax rates, the child tax credit, and the SALT deduction cap could all revert to pre-2017 rules. But of all those changes, the one with the broadest impact might be the dramatic reduction of the standard deduction. This single change has the power to reawaken a sleeping giant in the world of personal finance: itemized deductions. As always, let's begin with our important reminder. This content is for informational and educational purposes only and should not be considered as tax, legal, or financial advice. Your personal situation is unique, and we encourage you to consult with a qualified professional for guidance specific to your circumstances. Our goal is to help you understand the concepts, so you can have a more informed conversation with your advisor. For the past several years, the vast majority of American taxpayers have taken the standard deduction. The TCJA made it so high that for most people, it simply didn't make mathematical sense to do anything else. It was the easier, and often more financially beneficial, option. Taking the standard deduction meant you didn't have to track specific expenses. You just took the flat amount allowed for your filing status, and that was that. But if the standard deduction is cut nearly in half, as it is scheduled to be in 2026 for the 2025 tax year, the entire equation changes. Suddenly, for millions of households, the total of their individual deductible expenses might be greater than the new, lower standard deduction. This is the world of itemizing. So what does it mean to itemize? Simply put, instead of taking a single lump sum deduction, you are choosing to list out, or itemize, your specific legally deductible expenses on a form called Schedule A, which you attach to your main tax return. The goal is to see if the total of your itemized deductions is more than the standard deduction. If it is, you choose to itemize because it results in a lower taxable income, and therefore a lower tax bill. With that in mind, what are some of the common itemized deductions that might become much more relevant to people in 2025? First, there's the deduction for state and local taxes, or SALT, which we mentioned in the last chapter. If the $10,000 cap is removed, people who itemize could potentially deduct the full amount of their state income taxes and property taxes. For homeowners in many states, this deduction alone could easily surpass a lower standard deduction amount. Second is the mortgage interest deduction. For homeowners with a mortgage, the ability to deduct the interest paid on their home loan is a significant financial consideration. Under current law, there are limits on how much mortgage debt qualifies for the interest deduction. If the TCJA expires, these limits are scheduled to change, reverting to a higher debt limit of $1 million for older mortgages. This could be a powerful incentive to itemize for those with substantial mortgage balances. Third, we have charitable contributions. When you donate to a qualified charity, you may be able to deduct the value of that donation. This includes cash donations as well as the fair market value of donated goods. Under the high standard deduction of the TCJA, many people received no direct tax benefit for their generosity. If they didn't itemize, their charitable giving didn't reduce their taxable income. In a world with a lower standard deduction, every donation, large or small, could once again play a direct role in your tax calculation, provided you are itemizing. A fourth major category is the deduction for medical and dental expenses. This one is a bit more complex. The tax code allows you to deduct the amount of your unreimbursed medical expenses that exceeds a certain percentage of your adjusted gross income, or AGI. Currently, that threshold is 7.5% of AGI. This means if your AGI is $100,000, you can only deduct the medical expenses that are over $7,500. Because of this high threshold, it can be challenging to claim, but for those who have a year with significant out-of-pocket medical costs, it can be a very important deduction. The potential return to widespread itemizing means one thing above all else: the renewed importance of meticulous record-keeping. When you take the standard deduction, you don't need to prove your expenses. When you itemize, you do. This means holding on to receipts, bank statements, and acknowledgments from charities. It means keeping a clear record of property taxes paid, and getting the year-end mortgage interest statement from your lender. You don't have to wait until 2025 to get into the habit. You can start now by creating a simple system. This could be a physical folder for paper receipts, a digital folder on your computer, or using a spreadsheet or app to track deductible expenses as they occur. The key isn't the complexity of the system, but the consistency of using it. Having organized records makes tax time smoother and ensures you can properly account for all your potential deductions. It's about building a habit of financial awareness. In our next chapter, we will shift our focus to families. We will explore the potential changes to the child tax credit and other dependent-related tax benefits, and discuss what these shifts could mean for household budgets in 2025 and beyond. Hello and welcome back. In our last chapter, we explored the potential return of widespread itemizing due to the scheduled reduction of the standard deduction. Now we turn our attention to another area of the tax code that is critically important for millions of American households: tax benefits for families with children. The Tax Cuts and Jobs Act, or TCJA, significantly altered this landscape, and its potential expiration at the end of 2025 could bring another wave of major adjustments that parents and guardians need to be aware of. As we proceed, please remember that this discussion is for educational purposes only. It is intended to provide general information about potential changes in tax law, not to offer financial or tax advice. Every family situation is different, and we strongly encourage you to consult with a qualified tax professional to review your specific circumstances and plan accordingly. The centerpiece of family tax benefits is the child tax credit, often called the CTC. The TCJA made this credit more generous and available to more people. Under the TCJA rules that we have become familiar with, the credit is worth up to $2,000 for each qualifying child under the age of 17. The law also dramatically increased the income levels at which this credit begins to phase out. For married couples filing jointly, the phase-out doesn't start until their income reaches $400,000. This meant that many middle and even upper-middle-income families became eligible for the full credit for the first time. However, if Congress does not act, this expanded version of the CTC is set to expire. The tax code would then revert to the pre-TCJA rules. What would that look like? First, the maximum credit amount would be cut in half, falling from $2,000 back to $1,000 per qualifying child. For a family with 2 children, this represents a potential reduction of $2,000 in tax relief, a significant amount that would need to be accounted for in the family budget. Second, the income thresholds for qualifying would drop dramatically. Instead of phasing out at $400,000 for joint filers, the credit would begin to phase out at a much lower income level of $110,000 for married couples. For single and head of household filers, the threshold would drop from $200,000 to $75,000. This means that many of the families who have been receiving the credit for the past several years could find themselves earning too much to qualify for any of it, or would only qualify for a reduced amount. Third is the concept of refundability. A refundable credit is particularly powerful because if the credit is larger than the amount of tax you owe, the government sends you the difference as a refund. The TCJA made a portion of the CTC refundable, up to a certain inflation-adjusted amount, around $1,700 for 2025. If the law reverts, the rules around refundability are also scheduled to change. While a portion would remain refundable, the calculation and the maximum refundable amount per child would decrease to $1,000, and the earnings threshold to qualify for that refund would be slightly higher. This change would primarily affect lower-income working families who often have little to no income tax liability, but count on the refundable portion of the credit. Beyond the child tax credit, There is another important benefit for working parents: the Child Independent Care Credit. This credit is designed to help offset the costs of childcare for parents who need it in order to work or look for work. Unlike the CTC, the TCJA did not significantly alter this credit, but if the overall tax landscape changes, its importance could grow. Under the pre-TCJA rules, which are still largely in effect, this is a non-refundable credit. This means it can reduce your tax liability to zero, but you don't get any of it back as a refund beyond that. The amount of the credit is calculated as a percentage of your childcare expenses. The percentage you can claim depends on your income, and there's a cap on the amount of expenses you can use for the calculation: $3,000 for one qualifying person, or $6,000 for two or more. While the core of this credit is not directly part of the TCJA expiration, understanding its function becomes even more critical if the child tax credit is reduced. Families will need to be aware of all available avenues for tax relief. Proper documentation of childcare expenses, receipts from daycare centers, payments to babysitters, or records for summer camps will continue to be essential for claiming this credit. The potential changes to these family-focused credits underscore the importance of forward-looking financial awareness. A change in a tax credit is not just a number on a form. It can translate to real-world differences in a family's disposable income. Being aware of these potential shifts allows families to anticipate and plan for changes in their financial picture for 2025. In our next chapter, we will broaden our scope to discuss another group of taxpayers: small business owners, freelancers, and gig economy workers. We will examine the potential expiration of a major deduction known as the Qualified Business Income, or QBI, deduction and what that could mean for entrepreneurs. Hello and welcome back. So far in this series, we've discussed how the end of the Tax Cuts and Jobs Act, or TCJA, could impact individual tax rates, the standard deduction, and family-related credits. Now we're shifting our focus to the engine of the American economy: small businesses, freelancers, independent contractors, and gig economy workers. For this diverse and vital group, the TCJA introduced one of the most significant and complex new provisions in recent memory, and it too is scheduled to vanish at the end of 2025. Before we unpack this, please remember our standing disclaimer. This chapter provides general educational information about potential tax law changes. It is not, and should not be interpreted as, tax, legal, or business advice. The world of business taxation is incredibly nuanced. We strongly urge all business owners to consult with a qualified tax professional, or CPA, to navigate their unique financial landscape. The provision we are talking about is the Qualified Business Income Deduction, often known as the QBI deduction or the Section 199A deduction. In simple terms, this was a brand new tax deduction created by the TCJA specifically for pass-through businesses. What is a pass-through business? It's any business that isn't taxed as a separate C corporation. This includes sole proprietorships, which is how most freelancers and independent contractors file, partnerships, S corporations, and many LLCs. In these structures, the business itself doesn't pay income tax. Instead, the profits pass through to the owners, who then report that income on their personal tax returns and pay tax at their individual rates. The QBI deduction allows these business owners to deduct up to 20% of their qualified business income from their taxable income. For example, in a simplified scenario, a freelancer with $100,000 of qualified business income might be able to deduct $20,000, meaning they would only be taxed on $80,000 of that income. This has been a substantial tax benefit, designed to give a tax cut to Main Street businesses that mirrored the permanent tax cut given to large corporations. The key thing to know about the QBI deduction is that it is scheduled to expire completely after December 31, 2025. Unlike the other provisions we've discussed that are reverting to a previous rule, the QBI deduction didn't exist before the TCJA. So, if it expires, it doesn't revert to anything, it simply disappears. What would be the potential impact of this? The most direct consequence is a potential increase in the effective tax rate for millions of entrepreneurs. The income that was previously shielded by that 20% deduction would now be fully subject to ordinary income tax rates. When you combine this with the potential for those individual income tax rates to also increase, as we discussed in Chapter 2, the cumulative effect on a small business owner's tax bill could be significant. It's important to note that the QBI deduction has always had complex rules and limitations. For higher income taxpayers, the deduction could be limited based on the amount of W-2 wages the business paid, or the value of its property. Furthermore, owners of what were called specified service trades or businesses, like those in health, law, accounting, and consulting, faced even stricter income limitations. These complexities will disappear along with the deduction, but they will be replaced by the straightforward reality of a higher taxable income. The potential disappearance of the QBI deduction places an even greater emphasis on a fundamental practice for any business owner: diligent expense tracking. While the QBI deduction reduces taxable income after business profit is calculated, business expenses reduce your profit in the first place. Every legitimate business expense you track and deduct, from home office costs and vehicle mileage to software subscriptions and supplies, directly lowers your net business income. In a world without the 20% QBI deduction, the value of every single dollar in legitimate business deductions becomes that much more critical. It will be the primary tool for managing a business's taxable profit. This reinforces the need for clean, organized, and contemporaneous bookkeeping throughout the year, not just at tax time. The potential tax landscape of 2025 and beyond requires business owners to be more informed than ever. Understanding the mechanics of what might change is the first step towards strategic planning, and having productive conversations with a tax advisor about the structure of your business and your financial strategies for the coming years. In our next chapter, we will turn our attention to long-term planning. We'll discuss how the sunsetting provisions of the TCJA could influence strategies related to retirement savings and investments. Hello and welcome back. In our journey so far, we've explored how the potential expiration of the Tax Cuts and Jobs Act provisions could affect everything from your annual tax return to your small business. Now we're going to zoom out and look at the bigger picture: long-term retirement and investment planning. The tax rules of today can have a profound impact on your financial well-being decades from now, and the changes on the horizon for 2025 make this a critical time to be informed. As we delve into these topics, it is imperative to repeat our foundational disclaimer. The information presented here is for educational purposes only. It is not investment, financial, or tax advice. Decisions about retirement accounts and investment strategies are deeply personal and have long-term consequences. We strongly encourage you to work with qualified professionals, such as a financial advisor and a tax expert, to create a strategy that aligns with your specific goals and risk tolerance. One of the most fundamental decisions in retirement saving is the choice between a traditional IRA or 401k and a Roth IRA or 401k. The main difference lies in when you pay the taxes. With a traditional account, you typically contribute pre-tax dollars, which can lower your taxable income today. Your money grows tax-deferred, and you pay income tax on the withdrawals you make in retirement. With a Roth account, you contribute post-tax dollars, so there's no upfront tax deduction. But your money grows completely tax-free, and qualified withdrawals in retirement are also tax-free. The question of which is better often hinges on your expectation of future tax rates. The general thinking is if you expect to be in a lower tax bracket in retirement, a traditional account might be advantageous. If you expect to be in the same or a higher tax bracket, a Roth could be more beneficial. This is where the TCJA expiration becomes highly relevant. As we discussed, individual income tax rates are scheduled to increase in 2026. This potential for higher tax rates in the future is a significant factor to consider. Someone might look at the lower tax rates in effect through the end of 2025 as an opportunity. Paying taxes on Roth contributions now, at potentially lower rates, could be seen as preferable to paying taxes on withdrawals decades from now at what might be higher rates. This same logic applies to Roth conversions, where an individual chooses to convert funds from a traditional IRA to a Roth IRA, paying the income tax on the converted amount in the year of the conversion. Next, let's touch upon investments held in taxable brokerage accounts. The primary tax consideration here is capital gains tax. This is the tax you pay on the profit when you sell an asset, like a stock, for more than you paid for it. The TCJA did not dramatically overhaul the long-term capital gains tax rates, which remain at 0%, 15%, and 20% for most taxpayers, depending on their income. These rates are not tied to the ordinary income tax brackets in the same way they were before the TCJA, but they do have their own income thresholds. While the capital gains rates themselves are not scheduled for a major reversion like the income tax brackets are, the overall tax picture is still important. A higher ordinary income tax bill could mean less disposable income available for investing. Furthermore, for very high earners, investment income can be subject to an additional 3.8% net investment income tax. Understanding how all these pieces fit together is key to a holistic financial strategy. The uncertainty of the future tax code also highlights the value of a concept known as tax diversification.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
This simply means having savings in different types of accounts, pre-tax like a traditional 401k, tax-free like a Roth IRA, and taxable like a brokerage account. Having this flexibility in retirement can be incredibly powerful. It gives you the ability to strategically withdraw funds from different accounts to manage your taxable income each year, giving you more control over your tax bill when you no longer have a steady paycheck. Finally, a shifting tax environment can also bring strategies like tax loss harvesting into focus. This is a strategy used in taxable investment accounts, where an investor sells an investment that has lost value. This realized loss can then be used to offset capital gains from other investments. If losses exceed gains, a certain amount can even be used to offset ordinary income. In a year where tax rates might be changing, being aware of strategies that can help manage tax liability on investment gains becomes even more pertinent. Ultimately, the potential tax changes of 2026 serve as a powerful reminder that tax planning isn't just about the here and now. It's about building a resilient financial future that can adapt to a changing legislative landscape. In our next chapter, we will address a topic that affects many high-net-worth individuals: potential changes to estate and gift taxes, and what the TCJA sunset could mean for legacy planning. Hello, and welcome back to our series on preparing for the 2026 tax season. We've spent the last several chapters discussing how the expiration of the TCJA might affect your income taxes, your business, and your retirement planning. Now, we're going to address a topic that may seem distant for many, but is of critical importance for those concerned with legacy and multi-generational wealth transfer: the federal estate and gift tax. This is another area where the TCJA created a monumental, but temporary, change that is scheduled to end. Before we proceed, it's crucial to underscore our regular disclaimer. This discussion is for general informational and educational purposes only. Estate planning is a highly complex and personal legal and financial process. The information provided here is not legal or tax advice. We strongly recommend consulting with a qualified estate planning attorney and a tax professional to discuss your individual situation and objectives. So what is the federal estate tax? In simple terms, it's a tax on the transfer of a person's assets to their heirs after their death. The gift tax is its counterpart for the living, applying to the transfer of assets during a person's lifetime. The two are linked by a concept called the unified credit, which provides a lifetime exemption. This is the total amount of assets you can give away during your life and at death before any federal estate or gift tax is owed. The Tax Cuts and Jobs Act made a dramatic change to this exemption. It effectively doubled the amount from its 2017 level. Through annual inflation adjustments, this exemption has grown to a historic high. For the 2025 tax year, the federal estate and gift tax exemption is a remarkable $13.99 million per individual. For a married couple, this amount is portable, meaning a surviving spouse can use any unused portion of their deceased spouse's exemption. This effectively allows a married couple to shield nearly $28 million from federal estate and gift taxes. Because of this incredibly high threshold, the federal estate tax has affected a very small percentage of the wealthiest Americans in recent years. Many families who might have had to plan around the estate tax a decade ago found that their estates fell well below the new, higher exemption amount. However, just like the other individual provisions of the TCJA, this doubled exemption is temporary. It is scheduled to sunset at the end of 2025. On January 1, 2026, the exemption amount is set to revert to its pre-TCJA level of $5 million, adjusted for inflation since 2011. Projections estimate this will land the exemption somewhere in the range of $7 million per person. This is not a gradual decrease, it's a cliff. The exemption is poised to be cut nearly in half overnight. This means that many individuals and families who are not subject to the estate tax today could find their estates are suddenly above the new, lower threshold come 2026. An estate that is comfortably non-taxable under the 2025 rules could face a substantial tax liability at a 40% rate on amounts above the new exemption if the owner passes away in 2026. This impending change has brought a sense of urgency to the world of estate planning. Individuals with estates valued above the projected 2026 exemption amount may be exploring strategies with their advisors to take advantage of the current, higher exemption before it disappears. The Internal Revenue Service has issued regulations confirming that there will be no clawback. This means that individuals who use the higher exemption for lifetime gifts before it sunsets will not be penalized if the exemption is lower at the time of their passing. It's also important to mention the annual gift tax exclusion. This is a separate rule that works alongside the lifetime exemption. In 2025, an individual can give up to $19,000 to any number of other individuals without it counting against their lifetime exemption or requiring them to file a gift tax return. A married couple can combine this to give up to $38,000 per recipient. This is a powerful tool that can be used annually to transfer wealth without chipping away at the larger lifetime exemption amount. The scheduled reversion of the estate and gift tax exemption is a clear example of how legislative changes can dramatically alter long-term financial and legacy planning. It highlights the importance of regularly reviewing your estate plan with qualified professionals to ensure it aligns with your goals and the current legal landscape. In our next chapter, we will shift gears and begin to look forward. We'll discuss practical steps and strategies for organizing your financial life in 2025 to prepare for whatever the 2026 tax season may hold. Hello and welcome back. Over the past 7 chapters, we have journeyed through the complex landscape of the U.S. tax code, focusing on the major changes scheduled for the end of 2025. We've discussed everything from income tax rates to estate planning. Now it's time to bring the conversation down to a very practical level. Knowing what might happen is one thing, knowing how to prepare for it is another. This chapter is all about actionable ideas and organizational habits you can build in 2025 to face the 2026 tax season with confidence, regardless of what the final laws look like. As always, we must start with our important reminder. This is an educational discussion, not financial or tax advice. The ideas presented here are general best practices for financial organization. We strongly encourage you to consult with your own qualified tax and financial professionals to determine the best course of action for your unique situation. The single most powerful habit you can cultivate in 2025 is consistent record keeping. As we explored in Chapter 3, the potential for a lower standard deduction means millions of Americans may need to itemize their deductions again. You cannot do this effectively if you wait until January 2026 to hunt for receipts from a year ago. So what does good record keeping look like? It doesn't have to be complicated. Start by creating a system. This could be a simple set of labeled folders. One for medical expenses, one for charitable donations, one for property tax statements, and so on. Or you could go digital. Create a folder on your computer or cloud drive and scan or take photos of receipts as you get them. Many banking and budgeting apps also allow you to tag transactions that might be tax relevant. The tool you use is less important than the habit of using it consistently. A few minutes each month to organize your documents can save you hours of stress and potentially overlooked deductions at tax time. The second practical step is to perform a paycheck checkup. Your employer withholds income tax from each paycheck based on the information you provide on your Form W-4. The goal is to have the amount withheld be as close as possible to what you'll actually owe for the year. If too little is withheld, you get a surprise tax bill. If too much is withheld, you're essentially giving the government an interest-free loan that you won't get back until you file your return. In a year of potential tax rate changes, reviewing your withholding is especially important. The IRS has a helpful tax withholding estimator tool on their website, irs.gov. You can use this tool to see if your current withholding is on track. It allows you to input your expected income, dependents, and other factors to give you a projection. Based on the results, you can decide if you want to submit a new W-4 to your employer to adjust your withholding. Understanding this part of your finances gives you more control over your take-home pay and helps you avoid unwelcome surprises. A third step is to consolidate and organize your financial accounts. Do you have old retirement accounts from previous jobs? Do you know where all of your investment and bank statements are? The year 2025 is an excellent time to get a clear picture of your entire financial life. Make a list of all your accounts: checking, savings, investments, retirement, and credit cards. Know your logins and ensure your contact information is up to date on all of them. Having this information in one place not only simplifies your own life, but is invaluable if a family member ever needs to help manage your affairs. Finally, consider assembling your team of professionals before you need them in a crisis. This doesn't just mean finding a tax preparer in March. It could mean having an initial consultation with a certified public accountant, CPA, or a financial advisor early in the year to discuss the potential changes. These professionals can provide personalized insights based on your numbers and goals. Building a relationship with a trusted advisor when you're not under a tight deadline allows for more thoughtful and strategic conversations. By focusing on organization, reviewing your withholding, consolidating your financial picture, and building your team, you are creating a foundation of control and preparedness. These steps are beneficial no matter what happens in Washington. They empower you to be an active participant in your own financial journey. In our next chapter, we'll look at the legislative side of things. We'll discuss the different possibilities of what Congress might do about the expiring TCJA provisions, and how to stay informed without getting overwhelmed by the political noise. Hello and welcome back. In our previous chapter, we focused on practical, organizational steps you can take in 2025 to prepare for the upcoming tax season. Now we are going to turn our attention to the source of all these potential changes: the United States Congress. The scheduled expiration of the Tax Cuts and Jobs Act provisions has set the stage for one of the most significant legislative debates in years. Understanding the possible outcomes can help you contextualize the news and manage expectations for the future. As we navigate this topic, it's more important than ever to emphasize our core principle. This is a nonpartisan, educational discussion. We are not endorsing any political party, policy, or outcome. Our goal is to simply outline the primary scenarios that are being discussed by policymakers and analysts, so you can be a more informed observer of the process. This is not a prediction. It is an exploration of possibilities. Broadly speaking, there are three main paths that Congress could take regarding the expiring TCJA provisions. The first and simplest scenario is a full expiration. If Congress does nothing, the default outcome we have discussed throughout this series will occur. On January 1, 2026, the individual income tax rates, the standard deduction, the child tax credit, the QBI deduction, and the estate tax exemption will all revert to their pre-TCJA forms. This do-nothing approach would lead to a significant tax increase for a majority of American households, and would represent the most dramatic single-year shift in the tax code in recent history. While this is the baseline under current law, many observers consider this scenario unlikely due to the widespread impact it would have on taxpayers across all income levels. The second scenario is a full and permanent extension. In this version of events, Congress would vote to make the individual tax cuts from the TCJA permanent, just as most of the corporate tax changes were. This would essentially maintain the status quo for individual taxpayers. The tax brackets would remain as they are, the standard deduction would stay high, and the expanded child tax credit would continue. This path would provide predictability for taxpayers, but would also come with a significant long-term cost to the U.S. Treasury, as it would lock in lower tax revenues for the foreseeable future. This outcome is a major goal for some policymakers, but it would likely face considerable opposition from those concerned about the national debt. This brings us to the third, and what many analysts believe is the most likely scenario: a compromise or a partial extension. This is the messiest and most unpredictable path, but it is often how major legislation is made. A compromise could look like almost anything. Lawmakers could decide to extend the lower tax rates, but let the standard deduction revert. They might keep the expanded child tax credit, but lower the income threshold at which it phases out. Perhaps they will create a new, smaller version of the qualified business income deduction for small businesses. This mix-and-match approach would involve extensive negotiation. Every single provision of the TCJA that is set to expire would be on the table. The final bill could be a hybrid of old rules, current rules, and entirely new ideas. For taxpayers, this scenario means living with a high degree of uncertainty throughout 2025 as these debates unfold. The final tax laws for 2025 and beyond might not be known until the very end of the year. So, with all this potential for change and political debate, how can you stay informed without getting overwhelmed? The key is to choose your sources wisely. Look for nonpartisan organizations that analyze tax policy. Groups like the Tax Foundation, the Urban Brookings Tax Policy Center, and the Committee for a Responsible Federal Budget often provide detailed, data-driven analysis without advocating for a specific political outcome. Official sources such as the Congressional Budget Office (CBO) and the Joint Committee on Taxation (JCT) also publish objective reports on the financial impact of various proposals. Following these types of sources can give you a clearer picture of what is being proposed and what its effects might be, away from the heated rhetoric of daily political news. Ultimately, the tax laws for 2026 are not yet written. The discussions and decisions made in Washington over the coming year will directly impact the financial lives of all Americans. By understanding the possible scenarios, you can better interpret the headlines and focus on what you can control: your own financial organization and preparedness. In our next chapter, we will begin to synthesize everything we've learned. We'll discuss how to build a flexible tax strategy that can adapt to the uncertainty of 2025. Hello and welcome back. In our journey so far, we have dissected the specific provisions of the Tax Cuts and Jobs Act that are set to expire. We've explored what the legislative possibilities might be and discussed the practical steps of getting organized. Now it's time to synthesize this knowledge. This chapter is about moving beyond specific rules and focusing on building a flexible, resilient financial framework that can adapt, no matter what the final tax laws for 2025 and beyond look like. As always, we must begin with our essential disclaimer. This discussion is designed to be educational, providing you with concepts and principles for consideration. It is not financial, investment, or tax advice. A truly flexible strategy is one that is personalized to you, and that can only be built in consultation with qualified professionals who understand your complete financial picture. The first principle of a flexible strategy is to focus on what you can control. You cannot control what Congress will do. You cannot control whether tax rates will go up or down, but you can control your own financial habits. This means embracing the organizational practices we discussed in Chapter 8. Consistent record keeping, understanding your cash flow, and having a clear inventory of your financial accounts are the bedrock of any sound strategy. Good habits are valuable in any tax environment, and they become absolutely critical during times of uncertainty. The second principle is to embrace the concept of tax diversification. We touched on this when discussing retirement, but it's a powerful idea that applies more broadly. It means you don't put all your eggs in one tax basket. Having a mix of accounts, pre-tax, like a traditional 401k, tax-free, like a Roth IRA, and taxable, like a brokerage account, gives you options. In a year where tax laws might change, having the ability to choose where you save or where you draw money from can be a significant advantage in managing your overall tax liability. The legislative uncertainty of 2025 makes it a particularly relevant year to understand the mechanics of both traditional and Roth contributions, and to consider how each might fit into your long-term plan. The third principle is to shift from seasonal tax preparation to year-round tax awareness. Many people think about taxes for a few weeks in the spring. A flexible approach means thinking about the tax implications of your financial decisions throughout the year. For example, when you sell an investment, you might consider the capital gains impact. When you make a large charitable donation, you can be mindful of the documentation needed if you end up itemizing. This isn't about being a tax expert. It's about building a simple habit of asking, is there a tax dimension to this decision? This proactive mindset helps you avoid year-end scrambles and make more informed choices. The fourth principle involves simple scenario planning. You don't need complex software for this. It's a mental exercise you can do with your financial advisor or on your own. Ask basic, what-if questions. What if the standard deduction is cut in half? Would I be close to itemizing? What if tax rates go up by a few percentage points? How might that affect my take-home pay? What if the child tax credit is reduced? How would that impact my family's budget? Thinking through these potential scenarios helps you mentally prepare for change and can highlight areas of your financial life that might need attention. It transforms uncertainty from a source of anxiety into a catalyst for proactive planning. Finally, a flexible framework relies on a strong team. The tax code is complex, and it's likely to remain so. Having a trusted, qualified tax professional you can communicate with is not a luxury. It's a key part of a sound financial strategy. Use 2025 to find an advisor you are comfortable with, and have a conversation before the tax season rush begins. Ask them how they are helping clients prepare for the potential legislative changes. Their answers will tell you a lot about their approach. By focusing on these principles, controlling your habits, diversifying your tax exposure, maintaining year-round awareness, planning for different scenarios, and building your professional team, you create a strategy that isn't dependent on a single tax law. You build a durable financial framework that is ready for whatever comes next. In our next chapter, we will look at some of the common myths and misconceptions that often arise during times of tax law changes, and how to separate fact from fiction. Hello and welcome back to our series. In times of financial uncertainty and potential legislative change, misinformation can spread quickly. It's easy to come across a piece of advice on social media or hear a fact from a well-meaning friend that is incomplete or just plain wrong. This chapter is dedicated to clearing the air. We're going to tackle some of the most common myths and misconceptions about U.S. taxes to help you build your financial knowledge on a foundation of facts. As we go through these, please remember our standard disclaimer. This is educational content, not personalized tax advice. These general principles are for informational purposes, and you should always consult with a qualified tax professional regarding your own specific situation. Let's start with one of the biggest myths, especially around tax filing season. Myth number 1, getting a big tax refund is a good thing. It's like a bonus from the government. The reality is quite different. While it feels good to get a large check, a big refund typically means you overpaid your taxes throughout the year. You had too much money withheld from your paychecks. In effect, you gave the federal government an interest-free loan with your own money. The refund is simply the government paying you back. From a financial planning perspective, the ideal situation is to owe nothing and get nothing back, to have your withholding match your actual tax liability as closely as possible. That way, you have access to your money throughout the year to save, invest, or manage your expenses, rather than waiting for the government to return it to you months later. Myth number 2, tax laws and big changes, like the TCJA expiration, only really affect wealthy people. This is a pervasive but incorrect belief. While high-income earners are certainly impacted by tax law changes, the provisions we've been discussing have a direct effect on nearly every taxpayer. The standard deduction is a perfect example. A change to it affects tens of millions of low- and middle-income households. The child tax credit is another provision aimed squarely at working families. Changes to the lower-end tax brackets can impact the take-home pay of a recent graduate, just as much as changes to the top bracket affect a CEO. The tax code is interconnected, and shifts in one area have ripple effects across the entire economic spectrum. Myth number 3, if you're a student, you don't have to file a tax return. This is a dangerous misconception. The IRS doesn't have a special exemption just for being a student. Your requirement to file a tax return is based on your gross income, your filing status, and whether you can be claimed as a dependent by someone else, not on your student status. Many students work part-time jobs or have side hustles that generate income. Even if a student earns less than the filing threshold, it can often be beneficial for them to file a return. If any federal income tax was withheld from their paychecks, the only way to get that money back is by filing a tax return to claim a refund. Myth number 4, if you don't receive a Form 1099 or W-2 for income you earned, you don't have to report it. This is absolutely false. Your responsibility to report income is not dependent on whether you receive a piece of paper for it. All income is taxable unless specifically excluded by law. This includes cash you earned from a side job, payments received through a digital app for goods or services, and income from hobbies that turn a profit. The reporting forms like the W-2 and 1099 are simply informational documents that are also sent to the IRS. The legal obligation to report the income rests with you, the taxpayer, regardless of the paperwork involved. Myth number 5, filing for an extension gives you more time to pay your taxes. This is one of the most misunderstood rules. An extension, filed using Form 4868, gives you an automatic 6-month extension to file your tax return. It does not, however, give you an extension to pay the taxes you owe. Your tax payment is still due on the original deadline, typically April 15th. If you file an extension but don't pay an estimate of what you owe by the deadline, you will likely face penalties and interest on the unpaid amount. By understanding the truth behind these common myths, you become a more savvy and informed taxpayer. You can make decisions based on accurate information rather than popular fiction, which is a cornerstone of sound financial management. In our next chapter, we will discuss the alternative minimum tax, or AMT, a parallel tax system that could become much more relevant to many taxpayers if the TCJA expires. Hello and welcome back. Throughout this series, we have been discussing the regular income tax system, the world of tax brackets, deductions, and credits that most of us are familiar with. But there is another parallel tax system that has existed for decades, operating in the background. It's called the alternative minimum tax, or AMT. For the past several years, the TCJA made the AMT almost irrelevant for most people. But with the TCJA's provisions set to expire, this shadow system is poised to make a significant comeback, and it's something many more Americans may need to be aware of in 2026. Before we dive into this complex topic, a quick but essential reminder. This chapter is for educational purposes only. The AMT has incredibly nuanced rules, and this overview is not a substitute for professional tax advice. We are not providing any recommendations. To understand if or how the AMT might affect you, it is vital to consult with a qualified tax professional. So, what is the alternative minimum tax? It was originally created decades ago to ensure that high-income individuals who were using numerous deductions and tax breaks to significantly lower their tax bills would still pay at least some minimum amount of tax. Think of it as a separate way to calculate your tax. You essentially calculate your tax bill twice, once under the regular tax system, and once under the AMT rules. You then pay whichever amount is higher. Under the AMT, the calculation starts with your regular taxable income, but then you are required to add back certain deductions and income items that are allowed under the regular tax rules. For instance, the standard deduction is not allowed under the AMT. Most importantly, before the TCJA, the deduction for all state and local taxes, the SALT deduction, was a major item that had to be added back. Certain miscellaneous itemized deductions, and even the bargain element of incentive stock options are other common examples. After adding back these preference items, you subtract a large AMT exemption amount, and then apply the AMT tax rates, which are primarily 26% and 28%. The Tax Cuts and Jobs Act of 2017 dramatically reduced the reach of the AMT. It didn't repeal it for individuals, but it made two huge changes. First, it significantly increased the AMT exemption amount, the amount of income that is shielded from the AMT. Second, it massively raised the income level at which that exemption begins to phase out. Because these thresholds were so high, very few taxpayers ended up with a tentative minimum tax that was higher than their regular tax. Furthermore, by capping the SALT deduction at $10,000 for the regular tax, the TCJA eliminated what was historically the single biggest trigger for the AMT for many people in high-tax states. With these changes, the number of people subject to the AMT dropped from over 5 million to just a couple 100,000. Now let's look ahead to 2026. If the TCJA's individual provisions expire, the AMT rules are scheduled to revert to their old, less generous forms. The AMT exemption amount will decrease significantly. The income threshold where that exemption starts to phase out will also drop dramatically. Suddenly, with these lower thresholds, many more people could find themselves in the AMT zone. This is especially true for those who will benefit from other expiring TCJA provisions. For example, consider a family in a high-tax state. If the $10,000 SALT deduction cap disappears, they might be able to deduct $50,000 in state and property taxes on their regular tax return. This would be a huge benefit under the regular system. However, for the AMT calculation, they would have to add all $50,000 of that deduction back to their income. This one item alone could easily push their AMT liability above their regular tax liability, forcing them to pay the higher AMT amount and effectively wiping out the benefit of the uncapped SALT deduction. The return of personal exemptions would be another potential trigger. Under post-TCJA rules, these deductions would also need to be added back for the AMT calculation, further increasing the likelihood that one would be subject to the tax, especially for larger families. The potential resurgence of the AMT is a perfect illustration of how interconnected the tax code is. A change in one area, like the SALT deduction, can have a surprising and significant impact in another. Being aware that this parallel system exists is the first step in understanding your complete tax picture in a post-TCJA world. In our next chapter, we will discuss the importance of reviewing and potentially updating your beneficiary designations on various financial accounts as part of your overall financial checkup. Hello and welcome back to our series. As we navigate the complexities of the upcoming tax season, it's a perfect opportunity to broaden our perspective and conduct a more holistic financial checkup. Taxes are just one piece of a much larger puzzle. In this chapter, we are going to focus on a simple but incredibly powerful part of your financial life that is often set once and then forgotten: beneficiary designations. This is a critical area where a small amount of attention can prevent enormous future complications for your loved ones. As we delve into this topic, please remember our essential disclaimer. This is an educational discussion about a key aspect of financial planning. It is not legal or estate planning advice. Beneficiary rules can be complex and interact with state laws. We strongly recommend consulting with qualified legal and financial professionals to ensure your overall estate plan is sound and your wishes are properly documented. So, what is a beneficiary designation? Simply put, it is your instruction on an account or policy, telling the financial institution who should receive the assets upon your passing. You will find these on a wide variety of accounts, including retirement accounts like 401k, S403bs and IRAs, life insurance policies, annuities, and some bank or brokerage accounts, which may be labeled as payable on death, POD, or transfer on death, TOD. Here is the single most important thing to understand about these designations. In almost all cases, a beneficiary designation on an account will override any instructions you have written in your will. Let me repeat that, because it is that crucial. The beneficiary form is a direct contract between you and the financial institution, and they are legally bound to pay the assets to the person or people named on that form.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided,
regardless of what your will says. You can imagine the unintended consequences this can cause. A person might create a will that carefully divides their assets among their 3 children. However, if an old 401k from a job they left 20 years ago still names only their eldest child as the beneficiary, the entire value of that 401k will go directly and solely to that one child. Their will would be powerless to change that outcome. It's a common and heartbreaking scenario that can lead to family disputes and outcomes the account holder never intended. This is why reviewing your beneficiary designations is not a one-time task. It is something that should be done periodically, and especially after any major life event. Did you get married? You'll likely want to add your spouse. Did you get divorced? It is critical to review and likely change the beneficiary designation away from an ex-spouse. Did you have a child? You'll want to consider how to provide for them. Did a named beneficiary pass away? You must update the form to name a new primary or contingent beneficiary. A contingent beneficiary, also known as a secondary beneficiary, is the person or entity you designate to receive the asset if your primary beneficiary is unable to. Naming a contingent beneficiary is a vital backup plan. If your primary beneficiary predeceases you and you have no contingent beneficiary listed, the account may have to go through the lengthy, public, and often costly court process known as probate. The probate court would then decide how the assets are distributed based on your will, or, if you have no will, based on state law. This entirely defeats the purpose of the beneficiary designation, which is to allow for a smooth and direct transfer of assets outside of the court system. So, what is the practical step here? The year 2025, a year we've dedicated to financial preparedness, is the perfect time to conduct a beneficiary audit. Make a list of all your accounts. For each one, contact the financial institution or log into your online portal and confirm who is listed as your primary and contingent beneficiaries. Don't assume you remember correctly. Verify it. If the information is outdated, request the proper form and update it. It is one of the simplest, yet most profound, actions you can take to ensure your financial legacy is handled exactly as you wish. In our next chapter, we will begin to wrap up our series by focusing on the mindset of financial wellness and how to stay engaged with your finances in the long run, beyond just 1 year of tax changes. Hello and welcome back. For the majority of this series, we have been focused on the mechanics of a major legislative event, the expiration of the TCJA. We've talked about rules, numbers, and strategies. But as we near the end of our journey, it's time to elevate the conversation. Because being prepared for one tax season is a task, building lifelong financial wellness is a mindset. This chapter is about cultivating that mindset, so that you remain in control of your financial life long after the debates of 2025 have faded. As we explore these broader concepts, please remember our consistent disclaimer. This is an educational discussion about financial attitudes and habits. It is not psychological or financial advice. If you are experiencing significant financial stress or anxiety, please consider seeking help from qualified professionals, such as a financial therapist or a certified financial planner. Financial wellness isn't about being wealthy. It's not about never making a mistake. It is a state of being where you have a clear understanding of your financial situation. You feel in control of your day-to-day and month-to-month finances. You have the capacity to absorb a financial shock, and you are on track to meet your financial goals. The uncertainty of the 2026 tax season is simply a catalyst, an opportunity to build the habits that lead to this state of wellness. The first pillar of this mindset is to replace fear and procrastination with curiosity and action. For many people, personal finance is a source of anxiety. The fear of doing something wrong, of seeing numbers they don't like, or simply of not knowing where to start, can lead to complete avoidance. The antidote is to take one small, manageable step. You don't have to overhaul your entire financial life in one weekend. Maybe your first step is simply finding and organizing your financial statements, as we've discussed. Or perhaps it's reading one article about a financial topic you don't understand. Small wins build confidence and transform an overwhelming challenge into a series of achievable tasks. The second pillar is to embrace financial literacy as a lifelong journey. No one is born a financial expert. The world of finance is constantly evolving. A healthy financial mindset involves the humility to know you don't have all the answers and the curiosity to keep learning. You can do this by listening to reputable financial podcasts, reading books, or using online educational resources from government agencies like the Consumer Financial Protection Bureau or nonprofit organizations. The goal isn't to become a stock market genius. It's to build a solid foundational understanding of concepts like budgeting, saving, debt management, and basic investing, so you can make informed decisions and ask intelligent questions. The third, and perhaps most crucial, pillar is to define what success means to you. It's easy to fall into the trap of comparing your financial situation to that of your friends, neighbors, or people on social media. This is a recipe for dissatisfaction. True financial wellness is deeply personal. It starts with setting clear, meaningful financial goals that are aligned with your own values. What do you want your money to do for you? Do you want to travel? Do you want to achieve the security of being debt-free? Do you want to save for a child's education or retire early? Writing down these goals makes them real and provides a why behind your daily financial decisions. It gives your budget a purpose and turns saving from a chore into a fulfilling act of building the life you want. Finally, a wellness mindset includes scheduling regular financial checkups, just as you would for your physical health. Once a year, set aside time to conduct a personal financial review. Look at your progress toward your goals. Review your budget and see if it still reflects your priorities. Check your net worth to see the big picture of your assets and liabilities. Reevaluate your insurance coverage and, as we discussed, your beneficiary designations. Making this an annual ritual keeps you engaged and allows you to make small course corrections along the way, ensuring you stay on the path you've set for yourself. The tax changes of 2026 are an external event. By focusing on these internal principles, action over fear, continuous learning, personal goal setting, and regular reviews, you build a resilient financial foundation that can withstand any storm. In our final chapter, we will summarize the key takeaways from our entire series and leave you with a concise checklist for navigating the year ahead. Hello, and welcome back for the final chapter of our series on preparing for the 2026 U.S. tax season. We have traveled a long road together, from the highest levels of tax policy on Capitol Hill to the most practical details of organizing your financial life. The goal of this series was never to give you all the answers, but to empower you to ask the right questions. As we conclude, let's summarize the key takeaways and create a clear, simple action plan for the year ahead. As we do one last time, let's remember the purpose of this information. This has been an educational series designed to inform you about the potential changes to the U.S. tax code. It is not, and has never been, a substitute for personalized legal, financial, or tax advice from a qualified professional who can apply the law to your specific circumstances. Let's begin with a brief recap of the central issue, the Great Reversion. At the end of 2025, many of the individual tax provisions from the Tax Cuts and Jobs Act are scheduled to expire. This means we must be prepared for a potential return to pre-2017 rules, which could include higher individual income tax rates for many brackets, a standard deduction nearly cut in half, which would make itemizing deductions relevant for millions more taxpayers, a child tax credit that is smaller and available to fewer families, the complete disappearance of the 20% qualified business income deduction for small business owners and freelancers, a federal estate tax exemption cut by roughly half, impacting legacy and succession planning for more families, the potential for the alternative minimum tax, AMT, to affect a much larger number of taxpayers, especially those who itemize. Faced with this level of uncertainty, it's easy to feel overwhelmed. But as we learned in our later chapters, uncertainty is a catalyst for action. So here is a simple 5-point checklist for the year 2025. A set of proactive steps you can take to build a foundation of financial strength, no matter what the final laws look like. 1. Conduct a financial fire drill. This is all about organization. Take the time this year to gather and organize all your critical financial documents. Create a system for tracking potentially deductible expenses, like charitable donations and medical costs. Know where everything is. This single habit will save you immense stress and prepare you for any tax scenario. 2. Perform a paycheck checkup. Use the IRS withholding estimator tool to get a sense of whether your current payroll withholding is on track. Understanding how the Form W-4 works gives you direct control over your take-home pay and helps you avoid a surprise tax bill or a massive refund. 3. Audit your beneficiaries. This step goes beyond taxes. but is a critical part of your financial health. Log into your retirement accounts, check your life insurance policies, and verify that the people you have named to receive these assets are still the people you intend. Remember, these designations often supersede your will. 4. Schedule a money date. Whether it's by yourself, with your partner, or with a professional, put time on your calendar for a financial review. Look at your progress toward your personal goals. Is your budget still working for you? This isn't about judgment. It's about a calm, conscious check-in to ensure your finances are aligned with the life you want to live. 5. Assemble your team. Don't wait until you're in a jam to find help. If you don't have one, use this year to find a qualified and trustworthy tax professional or financial advisor. Building a relationship with an expert provides you with a resource you can turn to for guidance as the legislative landscape becomes clearer. This series was titled What to Expect in the 2026 Tax Season, but its true theme has been about taking control. It has been about shifting your mindset from a reactive taxpayer to a proactive manager of your own financial well-being. The laws may change, the economy may fluctuate, but the principles of good financial stewardship, organization, awareness, continuous learning, and thoughtful planning are timeless. You have taken the most important step by investing your time to become more informed. We hope this series has provided you with the clarity and confidence to navigate the year ahead and to continue building a bright and secure financial future. Thank you for joining us.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.